Most people think they're saving for retirement, but they're actually just building a massive ticking time bomb of a tax bill for their future selves. If you're blindly throwing money into a 401k because HR told you to, you are playing a dangerous game with the IRS, and you're likely losing. Today, we're ending the confusion. We're breaking down the Roth IRA versus the 401k and building a battle plan that ensures you keep every single dollar you earn.
Let's start with the hard truth. The government is your silent partner in every traditional investment account. When you put money into a traditional 401k, you're getting a tax break today, but you're giving the IRS a lien on your future. You're betting that tax rates will be lower in 30 years than they are now. Does that sound like a winning bet to you, considering the national debt? I didn't think so. That is why we need a strategy, not just a savings account.
First, let's talk about the 401k. It is the workhorse of the American retirement system. It has massive contribution limits, $23,000 a year for 2024. But its greatest power isn't the tax deduction, it's the employer match. If your company offers a 100% match on the first 5% of your salary, that is a 100% return on your money instantly. You will not find that in the stock market, crypto, or real estate. It is the only free lunch in finance. If you aren't taking the match, you are literally leaving your own salary on the table.
Now enter the Roth IRA. This is the secret weapon of the savvy investor. You don't get a tax break today. You pay your taxes up front. But after that, the government is out of your pocket forever. Every dollar of growth, every dividend, every massive capital gain is yours, 100% tax-free. In 2024, you can put away $7,000. It sounds small compared to the 401k, but because that money is clean, meaning no taxes are owed at the end, it's worth significantly more than a pre-tax dollar. Plus, the Roth IRA offers something the 401k doesn't: control. You can withdraw your contributions at any time for any reason without penalty. It's a retirement account that doubles as an emergency fortress.
So, which one wins? Neither. The ultimate strategy isn't about choosing one, it's about the order of operations. Most people do this wrong. They max out the 401k first because it's easy. Wrong move. Here is the blueprint for real wealth. Step 1. Contribute to your 401k only up to the point of the employer match, not a penny more. You want that 100.
Step 2. Pivot. Take every extra dollar and max out your Roth IRA. Why? Because the Roth IRA allows you to invest in anything, from low-cost index funds to individual stocks, without the high administrative fees often found in 401k plans. You are optimizing for growth and tax-free sovereignty. Once that $7,000 limit is hit, then and only then do you move to step 3. Go back to your 401k and fill the rest of that $23,000 bucket to lower your current taxable income.
Let's look at the math of why tax-free growth matters. If you invest $7,000 a year for 30 years at an 8% return, you end up with about $800,000. In a traditional 401k, if tax rates are at 25% when you retire, the IRS takes $200,000 of your hard-earned money. In a Roth IRA, you keep all $800,000. That's a $200,000 difference just for changing the type of account you used. That is the difference between a comfortable retirement and a restricted one.
But what if you make too much money for a Roth IRA? The IRS tries to gatekeep this wealth-building tool if you earn over a certain threshold. This is where the backdoor Roth strategy comes in. You contribute to a non-deductible traditional IRA and then immediately convert it to a Roth. It's a perfectly legal maneuver that the wealthy use to bypass income limits. Don't let the rules stop you. Learn how to navigate them. In the world of finance, if there's a wall, there's usually a side door built for those who know where to look.
And for those of you looking for the God mode of retirement, look into the Mega Backdoor Roth. If your 401k plan allows after-tax contributions and in-service distributions, you can potentially funnel an additional $40,000 plus into a tax-free Roth environment every single year. This is how the tech elite in Silicon Valley build multi-million-dollar tax-free accounts while everyone else is arguing over pennies. It's about leveraging the structure of the law to favor your future self.
The bottom line is this: you cannot control the economy. You cannot control the stock market.
You cannot control what the government decides to do with tax rates in 2050, but you can control the tax status of your assets. By diversifying your tax buckets, having some in pre-tax 401ks, and as much as possible in tax-free Roth accounts, you give yourself the ultimate flexibility. When you retire, you can pull from different buckets to stay in the lowest possible tax bracket. That is strategic mastery.
Don't wait for a better time to start. The power of these accounts is not in the timing of the market, but in the time in the market, specifically time spent growing tax-free. Audit your contributions today. Check your employer match. Open that Roth IRA. Your future self is either going to thank you for your foresight or curse you for your negligence. Choose wisely. Follow for daily wealth-building wisdom.